My presentation today is trying to beat the market. Why do most Australian active managers fail to beat their respective benchmarks? And what does it mean for investors like us? Kenneth French said in 2003 that the market is smarter than we are, and no matter how smart we get, the market will always be smarter than we are. This is quite interesting. If we look at the SPIVA Australia scorecard mid-year 2018, we find that over a 10-year period, almost 90% of international equity funds and more than 70% of Australian equity funds have underperformed their benchmark. Even though in contrast, more than half of Australian small cap funds have beaten their benchmarks. The situation is actually quite worse when we look at the persistence of Australian active funds, when we find that over the 12-month period ending June 2014, only 2.2% persistently maintained a top quartile rank. And out of 144 Australian funds that ranked in their respective top quartile in the 5-year period ending June 2013, less than half of them remained in the top 2 quartiles, and 15.3% were liquidated or merged in their subsequent 5-year period. So, why is it so hard to outperform the market? Well, according to Eugene Fama, who is the father of the efficient market hypothesis, he stated that markets are efficient, and that means that all the relevant information is already priced into the market, making the attempt of beating it futile. So prices reflect all aggregate expectations of market participants already, therefore making it difficult to try and find an advantage. In fact, if we look at the expected returns of the market, we can see that it's more luck than skill trying to beat the market. So there was a study done where over 3,000 US equity mutual funds from 1984 to 2006 were made, and they found that there was no evidence that trying to outguess the market prices has any value. If we look at the slide here, we can see that according to the capital asset pricing model, the green normal distribution of the market returns has a beta of 1 and an alpha of 0, and represents the expected returns for systematic risk over the risk-free rate. This is achieved when all unsystematic risk has been diversified out through a very well diversified portfolio. The distribution of actual returns of actual funds, active funds, net of high operational costs, is practically a whole standard deviation below the market returns, as you can see. Equally, if we look at the concept of equilibrium accounting and take into account that the entire market is an aggregate of both active and passive investors, if the fees and expenses of active investors B in this slide are higher than those of passive investors A, then active investors must in aggregate lose to passive investors all the time. So, looking at active versus passive investing, what is the main difference? The difference is the fact that passive management of funds essentially just replicates the composite portfolio of an index, whereas active management is trying to find irrationalities and inefficiencies within the index and trying to exploit them. So, if we want to look for returns, where can we find them? Where do they come from? Well, it's been found that fairly priced securities can have different expected returns from one another. If you remember back to the SPIVA scorecard, more than half of Australian small cap funds in fact beat their benchmarks. So, if we look at a model called the Fama-French 3-factor model, it states that in fact there are 3 factors or areas where their returns can be expected, and they are the difference between the returns on a diversified market portfolio and a risk-free return, in other words the equity premium, also on the difference between returns on diversified portfolios of small and large capitalization stocks, and also the difference between returns on diversified portfolios of high and low to book to market stocks. So if we can see evidence on this slide that the premiums or returns from these 3 factors over a 40-year period have in fact been more prevalent than not, as you can see in this slide here. So what does this mean for our investment philosophy? It means that we need to take advantage of the equity premium, take advantage of company size and relative price, that means the value premium, in order to tilt our portfolios to these three factors in order to get our desired returns. So let's make markets work for us. Consider expenses and turnover and make sure that we are diversified as much as possible and have our tilts in our portfolio to these three factors. Thank you.